Hi, welcome to Rental Sheets. This is Dave, the founder and developer of the Rental Sheets product, and this video tutorial is on how to analyze the purchase of your rental property. Many investors today are utilizing a strategy called BRRRR, in which you buy a distressed property at a discount, you rehab the property, rent the property out, and then you refinance the property with a long-term, low-interest loan. With the BRRRR strategy, the investor is buying distressed properties at a discount and then rehabbing the property to increase the after repair value to build in equity and profit into the deal at the time of the purchase, which is exactly what this purchase analysis calculator is used for. It's used to calculate the amount of equity and profit in the deal after you made the repairs to the property. But even if you're not buying a distressed property, maybe the property just needs a little bit of light rehab, or maybe you're buying a turnkey rental, this calculator can be used to calculate the amount of equity and profit you'll have in the deal at the time of your purchase. So basically, the purchase analysis is similar to a flip analysis. It takes the after repair value and then deducts all of your project costs, such as your purchase price, your buying costs, your repair costs, holding costs, selling costs, and your financing costs to calculate your profit. The first item to input is the after repair value. So this is the value of the property after you make the repairs to the property. Generally, for single family and small multifamily rentals, you will use recent comparable sales to determine your after repair value. Review your market and find similar recent comparable rental properties in the area that have sold to determine an approximate after repair value for your property after you make the repairs. The next step is your purchase and buying costs. Input an approximate purchase price or your known purchase price amount. This could be the asking price, or it could just be the price that you think you can get the property under contract for. Next, you can set up your buying costs. Your buying costs can be entered as a percentage of your purchase price or as a lump sum number. Generally, buying costs are going to be between 2 to 4% of the purchase price value. The next step is to set up your repair costs. The repair costs can be entered as a lump sum number, a dollar per square foot value, or the detailed amount that's calculated from the repair cost estimator. The dollar per square foot value multiplies your dollar per square foot amount by the property square footage to calculate your construction budget. Now, if you want to use a detailed estimate, the detailed selection will use the estimated construction cost value from our detailed repair cost estimator tool. The next section is your holding costs that you'll incur during the rehab. The holding costs are only the costs that you will incur during the time it takes to rehab the property to get the property into rentable condition. These costs are not going to be the holding costs during the actual rental operation. Your rental operating expenses will be set up on the rental analysis sheet. So first, input the number of months it will take you to rehab the property. Generally, a light rehab could take just a few weeks, with the heavy rehab taking up to 2 to 3 months. Next, you'll input the monthly holding costs for each item. Your total holding costs are then calculated by multiplying the number of months to rehab the property by the monthly holding costs. Next, you can set up your selling costs, which are the costs you will incur when you sell the property. You can input a lump sum number, or you can use a percentage of the after repair value. Generally, selling costs are going to be between 7 to 10% of the resale value. The last selection to consider is how you're going to fund your purchase and the repairs of the property. Now, if you're a cash investor, then your analysis is basically complete and you can review your calculated profit below. However, if you're going to be receiving outside funding for the initial purchase, you will click Outside Funding. Next, you can set up the type of funding that you will be receiving. If you are going to be receiving a long-term conventional loan up front to purchase the property that you will keep for the entire rental period, then you can select Conventional. Now, if you're going to be utilizing a short-term bridge loan to finance the initial purchase of the property that you're planning on refinancing with a long-term conventional loan later down the road, then select Bridge Loan. Now note, if you select Conventional Loan, you will end up setting up your conventional loan information on the rental analysis sheet later on, because this long-term financing and debt service calculation information are considered to be a part of your long-term rental operations. But if you're going to be utilizing a short-term bridge loan, you can set up your bridge loan information below. The first bridge loan information to set up is your loan amount. You can set up your loan amount by using the drop-down menu, or you can input a number directly into the cell. The drop-down options give you the option to get a bridge loan for just the purchase price, or you can get a loan for the purchase and the repairs. Once you make a loan selection, the calculator will automatically generate the loan amount based upon your purchase and repair data inputted above. Next, you will set up the loan-to-value ratio that your lender requires. Generally, lenders will lend at 65 to 80% of the purchase price, but this can vary widely depending on the lender, so make sure that you talk to your local lenders to determine their loan requirements. Next, set up the loan term, which is the number of months you will carry the short-term loan, which will likely be anywhere from 6 months up to 24 months. You can then set up your interest rate that your lender is charging. These rates can vary depending on the lender and the type of funding, so again, talk to your lenders to determine what rates they are charging for their bridge loans. And then finally, a lender will generally charge a few percentage points up front for originating the loan, so plug in 2 to 3% for the lender points. So now that we have set up our purchase information, the spreadsheet is going to calculate our rehab profit and cash outlay from the purchase. The rehab profit and equity in the deal after the rehab is calculated by taking the after repair value and subtracting out all of our project costs. So basically it's taking the after repair value and subtracting the purchase costs, your repair costs, your holding costs, and financing costs to calculate your profit and equity in the deal after the rehab. So in this scenario, the after repair value is $200,000 and we have roughly $182,000 in project costs. So our profit and equity in the deal is around $18,000. So at this point, we could basically just flip the property and make $18,000 on the deal, or if we choose to hold the property long term, we will have $18,000 in equity built into the deal that we can later cash out through a refinance. Your cash outlay is calculated by taking all of the project costs, excluding your selling costs, and deducting the loan you're receiving for the property. The balance between the project costs and the loan amount is the amount of cash you as the investor will have to invest in the deal to cover the remaining costs. The reason selling costs are excluded from this calculation is because selling costs are not paid for up front. They are only paid for when you sell the property, and they're generally paid for out of the proceeds of the sale. Now that we have analyzed the purchase of a rental property, we can move on to the next step, which is to perform a long-term rental analysis of the property rental income, operating expenses, and property cash flow. If you have any questions at all about the purchase analysis, please shoot us an email or give us a call.